buy real estate, accelerate depreciation, generate losses, and use those losses to offset income on your tax returns. Then, instead of selling your real estate later, you can swap it for more properties and never pay capital gains taxes, or you can simply borrow against your equity. This is exactly how the top 1% use real estate to avoid paying taxes. And today I'm going to show you the key tax loopholes and strategies you need to understand to accomplish this for yourself. I use these exact strategies to save my clients millions in taxes at mycpacoach.com. And today you're going to learn them for free. So please do me a favor and like this video below, and let's jump right in. Okay, so the trick to using real estate to reduce your taxes involve 3 simple steps. Number 1, buying or owning investment property, like long-term or short-term rentals, whether that be single family, multifamily, or commercial property. And then number 2, taking large amounts of depreciation, which usually creates a loss on your tax returns after deducting all of your other rental expenses. And then you can do number 3, using those losses to offset other income on your tax returns, like your W-2 income or your business income. So the first set of loopholes I'm going to share with you will focus mainly on number 2 and number 3 here, as there are several tax code provisions that you need to successfully maneuver through in order to make all of this work. But if you stay with me, I will also share some bonus loopholes that may also help you avoid taxes when selling your properties as well. So let's go ahead and get started with tax loophole number 1, accelerating your depreciation. Okay, so by default, when you own a rental property, you are only entitled to a very small depreciation deduction called straight line depreciation. Now, this method forces you to write off the entire purchase of your property over 27.5 years if it is residential property, or 39 years if it is commercial property. So if you had a $500,000 property, that will be equivalent to a $12,000 to $18,000 annual deduction depending on the type of property it is. But imagine getting a $100,000 deduction on the same exact property. Well, this is possible through taking advantage of a tax loophole that allows you to accelerate your depreciation. And it is called cost segregation, which is basically a study that segregates or separates part of your investment property to identify components that can be depreciated over shorter periods of time, like furniture, ceiling fans, fixtures, refrigerators, stoves, and other items that are usually individually depreciated over 5 or 7 years. Without a cost segregation study, these things are lumped into the property's overall depreciation rate, which is much slower, smaller, and ultimately less beneficial than depreciating these items over faster periods of time. Plus, tax provisions like bonus depreciation and Section 179 may allow up to 100% of these components to be expensed immediately instead of spreading them out over multiple years. And those provisions do not apply to the entire dwelling, but can apply to tangible assets located inside the property. These methods ultimately allow you to take more depreciation up front, which usually triggers a loss on your tax return, and then that loss can be applied to other income on your return to lower your taxes. But that assumes you can get around one problematic tax provision: the passive activity loss limitations. So according to the IRS, rental income and losses are considered passive, and they do not allow you to use passive losses to offset your active income, like income from your W-2 job or your business income. But that's where understanding the next few tax loopholes become very beneficial. The next 4 loopholes I'm about to share with you allows you to turn your passive losses into active losses that can be used to offset other income on your tax return. And all you need is for one of these loopholes to work for you in order to use real estate losses to reduce your taxes. So let's cover them, starting with the most popular methods, and then I'll go over some little known techniques as well. Okay, so tax loophole number 2, the real estate professional tax status. So if you qualify for this special tax status, the IRS will treat all of your real estate activities as active, therefore allowing you to use your rental losses against your ordinary income. And you don't need a professional license or certificate to qualify for this. It is purely based on your time and participation with your rental activities. Specifically, you can qualify if you meet 2 simple criteria. Number 1, you perform more than 750 250 hours of services in real estate during the tax year where you materially participated, which is less than about 15 hours per week. And number two, more than half of all of the services you perform for the year is in real estate trades or businesses. Now, I'll be honest, if you work a full-time job or business that is unrelated to real estate, this may be hard to qualify for. But in some instances, I have seen people qualify for this status through a spouse who does not work and can easily meet the time and participation requirements here. But generally, people who have the best chance to qualify for this status usually either manage their rental properties or investments on a day-to-day basis, and that is their primary job. But if you can't meet this requirement, don't worry, because we still have 3 other powerful loopholes that can help you here, like number 3, the short-term rental loophole. So check this. When you own a rental property where the average stay is 7 days or less, it is not considered a passive activity according to the IRS. It is considered a legitimate trade or business, which means if you own short-term rental properties like Vrbo or Airbnb properties and use depreciation to trigger these rental losses, you will be able to use those losses against your W-2 or business income. But in order for it to be considered a trade or business, you must still materially participate in managing your rental properties, which is defined by meeting one of the 7 material participation tests, which I'll also link for you in the description below. But ultimately, the IRS wants to see that you are participating in your rental activities on a regular, continuous, and substantial basis for your participation to be considered material. Now, the short-term rental loophole has gained a lot of popularity over recent years, but these next 2 loopholes are not discussed enough, which could still allow you to accomplish similar results. So let's talk about tax loophole number 4, the business use loophole. If your investment property is used in a non-rental activity, like a business that you own, then you may be able to take depreciation deductions against the income you earn in that business. This exception strictly applies to any interest that you may have in a partnership, S corporation, or joint venture that is conducting that business venture. If you own a business like this, then you may be able to trigger those large depreciation deductions in your business by buying commercial use property like office spaces, storage space, warehouses, or other types of property that may make sense for your business and offset your taxes. But if you do have rental property, then this may not be useful for you. Though you could potentially use tax loophole number 5, the C Corp rental tax loophole. Now, a lot of people don't know this or talk about this one, but in a C Corp, the IRS actually allows you to use passive losses to offset active income, which means that if you have these passive real estate losses going into a C corporation and also have active business income in that C Corp, then those rental losses will be able to offset that business income in that corporation and reduce your business taxes. You don't need to qualify for any special tax status for this or meet stringent participation rules. The only big caveat here is that those passive losses can only be used to deduct against net active income in that corporation. So if you do not have any other business income flowing into that corporation, then those losses would not serve you any benefit. C corporations are not flow-through entities, so those passive losses would not affect your personal tax return in any way. Any unused losses in that corporation would just carry forward to be used against future income generated in that C Corp. But if you earn a lot of income in your business and you desire to use rental losses to reduce your taxes, then incorporating a C Corp structure may be beneficial for you depending on your unique set of circumstances. Now let's take this a step further and move into some of our bonus loopholes, which may help you avoid additional taxes when liquidating your properties, like loophole number 6, the 1031 exchange. So whenever I talk about depreciation, there's always people talking about depreciation recapture, which basically forces you to claim all of the depreciation that you've taken over the years as income when you sell your properties. And this is very important to consider. But it's also very important to consider techniques to avoid this, like a 1031 exchange, for example. This allows you to effectively swap a property that you are selling for another one. And when done correctly, you would owe no tax on the sale of your property. Now, there are some stringent requirements to make this work, like identifying your replacement property within 45 days and completing your exchange within 180 days of selling your property. But ultimately, if you absolutely have to sell your property, then this may be a good technique to use to avoid capital gains tax. But if you're not a fan of that, there's also number 7, borrowing against your properties. Now, there are many reasons why someone might do this, but the tax reason is that you avoid taxes when you borrow money because those proceeds are not considered taxable income. Plus, the interest expense may be tax deductible depending on how you use the proceeds. Now, I already have an entire video on the buy, borrow, die strategy, but the premise is to buy and hold your real estate, borrow from them when you need capital, and when you die, your heirs would inherit the properties at their fair market value, not your depreciated basis in the properties. By doing this, you can reduce your taxes over your life while granting your heirs a fresh start to use similar strategies if they inherit your properties. So there's a lot that can be said about simply holding your investment properties instead of selling them, or using a 1031 exchange when you need to get rid of one. And if you do one of these two things, then you would never have to worry about capital gains tax. Now, there is a lot of complexity around every loophole that I just shared with you, and I would strongly recommend that you do not attempt these on your own. Please consult a licensed CPA that knows what they are doing to guide you through this. And if you need one, just go to mycpacoach.com to apply to work with my team of CPAs today. Thank you for watching.